Welcome back. Today, we're stepping right into a financial detective story. We are looking at Modine Manufacturing. Now, this is a company that has captured absolutely massive market momentum. But as seasoned investors know, what's red hot right now doesn't always line up perfectly with the fundamental reality underneath, right? So we're going to peel back the layers on this stock and see exactly what the data is telling us.
Let's start by considering a central mystery. What actually happens to a company's underlying fundamentals when its stock price surges over 1,000% in just 3 years? I mean, does the business scale at that exact same breakneck speed? Or does the market's enthusiasm kind of start to outpace the actual financial machinery of the company? Well, that's exactly what we need to unravel today. 1,077.64%. Think about that for a second. That is the jaw-dropping 3-year return for Modine Manufacturing. Generating this kind of explosive upward trajectory in just 36 months is incredibly rare. It immediately grabs your attention and forces us to ask, what kind of catalyst creates that level of relentless buying pressure?
And look, this momentum isn't just a sudden short-term blip or some meme stock flash in the pan. Year to date, they are up over 83%. Zoom out to 5 years, and the return is a staggering 1,360%. And over a 10-year horizon, a massive 2,141%. So this isn't a brief market anomaly. It's literally a decade-long wealth compounding machine. But compounding at this rate completely transforms a company's valuation, and continuous hype on this scale demands that we pop the hood and look at the engine actually driving the whole shebang.
Okay, let's dive into this. Section 1, Measuring the Growth Engine, the Revenue Reality.
So, to justify those massive historical returns, we have to look for actual cash coming through the front door. When we measure Modine's revenue compound annual growth rate, we see a very clear trend. Over the last 3 years, revenue grew at 8.43%. Over 5 years, it's slightly higher, sitting at 10.22%. But over the trailing 12 months, top-line growth has actually accelerated to 13.16%, bringing total trailing revenue to a very solid $2.87 billion. And, that acceleration is exactly what momentum investors want to see. The top-line growth is undeniably there, and importantly, it's speeding up.
Moving on to Section 2, Checking Financial Health, Profitability and Liquidity.
Now, as we all know, a healthy business isn't just about what you make, right? It's about what you keep. And here we run into what I like to call the profitability paradox. Over the last 5 years, Modine's net income grew at a really healthy compound annual rate of almost 20%. But look at the trailing 12 months, that growth has completely inverted, dropping by a severe 38.95%, leaving recent net income at $97.8 million. This kind of stark disconnect often happens when a company faces rising operational costs, margin compression, or maybe they're just in a heavy reinvestment phase. So while that revenue engine is revving up, bottom-line efficiency has definitely hit a major speed bump.
But hey, before that profit drop sounds all the alarm bells, checking these balance sheet metrics provides some necessary reassurance about the company's immediate stability. Their debt-to-equity ratio is actually quite manageable at 0.55. The current ratio is 2.19, meaning they've got more than twice the amount of short-term assets needed to cover their short-term liabilities. And even the quick ratio, which, strips inventory out of the equation to measure immediate liquidity, well, that sits comfortably above 1 at 1.28. So despite those recent struggles with net income growth we just talked about, this is still a highly liquid company that can very comfortably cover its debts and keep the lights on.
Which brings us to Section 3, the Valuation Reality Check, Pricing the Hype.
All right, so we've got a company with accelerating sales and a sturdy balance sheet, but they are taking a recent hit to bottom-line profits. Which brings us to the ultimate question. What is the market currently paying for this specific financial profile? 136.08. Yep, that is Modine's current price-to-earnings ratio. And just to give you some context on how stretched that actually is, it's sitting at 107% premium over the company's own trailing 12-month average. I mean, the market is paying an absolute premium right now for every single dollar of Modine's earnings.
And the other valuation multiples remain pretty lofty too. Price to sales is at 4.46, and price to book is at 11.53. But the cash reality is deflating rapidly beneath the surface. Take a look at the price to free cash flow ratio. It's negative 637.11. Let's translate that into plain English. Over the trailing 12 months, the company actually burned about $20.3 million in free cash flow. Pricing a stock this highly while it's generating negative free cash flow, that signals incredibly high, perhaps dangerously stretched, market expectations for future performance.
As an investor, the absolutely crucial point is how you objectively measure this soaring market price against the actual cash-generating reality of the business. You use a metric called the margin of safety. It's basically the percentage difference between a stock's calculated intrinsic value, usually based on a strict discounted cash flow model, and the price it's currently trading at on the open market. Now, keep this definition firmly in mind, because the data point coming up next, it kind of changes the entire perspective.
Negative 1,542.82%. No way, right? But that is the current margin of safety for Modine based on its free cash flows. It is a violently negative figure. And what this tells us, structurally speaking, is that the stock's current momentum has completely detached from the intrinsic value calculated by a traditional cash flow-driven valuation. Because discounted cash flow models strictly look at the actual cash a business is expected to generate and discount it back to today, they just don't care about market hype or momentum. They only care about hard, cold cash.
So, when we translate those percentages into actual dollars, the contrast is incredibly stark. Moderna's recent close price on the open market was an impressive $244.95 per share. However, the strict discounted cash flow fair value price, which is the anchor of its fundamental reality, is calculated at just $14.91. That is a massive structural gap, and it perfectly illustrates the intense tug-of-war going on here between a stock riding a decade of incredible market momentum and the grounded mathematical reality of its current cash flows.
Which leaves us with this final provocative thought. With a market price trading at roughly $244, but a strictly calculated fair value of just $14, is Modine Manufacturing successfully defying gravity through accelerating revenue? Or is this massive 1,000% run-up running on borrowed time? It really forces us to weigh the absolute thrill of momentum against the unyielding gravity of value investing. I'm going to leave that for you to ponder. Thanks for joining me to unpack these numbers in today's explainer, and we will see you next time to explore the reality behind the next big market mover.